Today, I have the great pleasure of sitting down with Bob Lamkins. He's a mortgage loan officer here at HillsBank. Now, HillsBank is a great local bank in the Iowa City area. They've been around for, over 100 years now, right?
About 117.
Wow. So we got a couple questions for Bob, and we just want to get an update on what's going on in the mortgage market. So the question I get asked the most when I'm working with buyers is, what is the difference between an in-house loan product and a secondary market product? Because the two are very different. Can you explain to a prospective buyer what that difference would be?
Yeah, absolutely. That's a great question. Well, the secondary market, what secondary that refers to is those are sold to investors. Those are your traditional 15-year, 30-year fixed rate loans that most people think they want and need, and oftentimes do.
Right. That's what we call a 30-year fixed, like a lot of people call, right?
A 30-year fixed,
yeah.
That's right. Our in-house loans are just what they say. We actually keep those, so we do not sell those on the secondary market. One major difference is they are not fixed rate loans for the entire 30 years of the loan. If you were to run it the whole 30 years, they're actually adjustable rate mortgages, ARMs, probably aware of those.
That's your most popular, probably.
That is our most popular, yep. And
but it's still amortized over 30 years, correct?
It's amortized over 30 years. The only difference is where the rate will only be fixed for the first number of set amount of years, whether that be 5 years, 7 years, or even all the way for 10 years.
Right.
But it's not.
Which are
fixed
really
the
good
whole
for
30.
like grad students, right? Like if a grad student's coming to town, I'll say, hey, how long are you going to be here? They're like, probably like 3 years. Well, then the 5-to-1 ARM would be a good product, right?
Be a fantastic product.
And then if they need a little bit more, they can do the 7-to-1, which is a little tick up probably in an interest rate, and then the 10-to-1's a tick up from that, right?
And that's
so
right.
you got the flexibility.
Yep.
And otherwise, you just need to refinance during that time, right? Like, so if you do a 10-to-1 and then on year 9, you just refinance.
Yeah, absolutely. They're great for first-time home buyers or anyone who knows they're not going to be in a home for 10, 12, 15 plus years. Because typically our in-house rates are going to be equal to or better than a fixed rate. The process is a little bit much easier, a little bit less documentation, paperwork. So the fixed rates are fantastic for those who will be there, but they're not the end-all, be-all. If a person's only going to be in a home for 5 years, what's the point of the 30-year fixed rate, right?
Right. You might be able to get a lower down payment or those sort of things. Yeah.
Absolutely.
I always explain it this way. So if you go secondary market, you have to fit in the box. You either fit in the box or you don't. But if you do the in-house, you have some more variables and flexibility in it. And a lot of times for first-time home buyers, you don't have the giant down payment that you need. And right. That's really helpful. Yeah,
and that's another big thing we offer in-house is fixed rate, you need at least a 3 to 5% down payment, with the exception of a couple government loans, USDA, VA. Our in-house, we can do no down payment loans, for those that qualify. And it does work great for, your grad students, going to medical school, or just your first-time home buyers.
My first 2 houses were in-house.
Yeah, and they work fantastic, and we don't have that PMI, the private mortgage insurance, that a fixed-rate loan would have if you do not have a full 20% down payment.
That's a good thing to know.
Condominiums, fixed-rate loans have special rules for condominiums, so you may qualify for the fixed rate, but the condominium itself also has has to qualify, and those require, like one special rule is a minimum of a 10% down payment. Our in-house loans do not have those special rules for condominiums. Treat them the same as a single-family home.
Well, it's good that there's both options, and I'm glad that you kind of explained this a little bit, because that is a huge question that I get all the time. Let's jump into this big update that just happened this fall. So we just increased the amount of the conventional loan?
Yes, by quite a bit. The maximum loan amount for a conventional loan, which would be the secondary market loans we were just talking, or our in-house loans, was $548. Now it's going up to $640.
Yeah, but that's an 18% increase. Yeah. That's a big increase.
Yeah, it makes a big difference. So that kind of eliminates the need for what used to be called the jumbo loans. We can do a loan up to $640,000 on a conforming conventional, which gets you a much better rate.
If you're in the luxury market, and you say you're buying $1 million house, I mean, at 3% interest rate today, I mean, the opportunity cost is twice that in the stock market, right? So you might as well take that out. Now you can go all the way up to that 640. That's big news. That's going to be really nice.
Yeah. Now, you always want to keep in mind when you get into these higher price homes, these luxury homes, there are certain down payment requirements on them. Like, for example, the 100% financing does not work on the higher priced homes.
Which it shouldn't.
Right. But yeah, if you got $1 million home, you can easily go up to that 640 number.
That's great. Well, the big question that everyone wants to know is what's going to happen with interest rates. And clearly they're going to go up. But how much is kind of the battle right now, right? Like, so the Fed is trying to fight in the inflation that's going on. So we saw roughly 6%, I think it was like August and September, which is record since early 1980s. So they're really trying to fight that. And the Fed's only way to really fight the inflation is to raise the interest rates. So the Fed had indicated that they were going to go over 4%. And then Omicron hit right around Thanksgiving. And now it's suddenly like the Fed versus Omicron. What is going to happen? Because Omicron is suddenly, all these forecasts are that it's going to slow growth in 2022. And we're going to this pandemic just is going to go into a third year. So we have this battling forces. What do you think is going to happen with interest rates next year?
Well, that is the $1 million question. Like you said, we all want to know, right? I do think they're going to go up just based on everything we see and all the forecasts out there in the modeling. The Fed said they're looking to maybe raise rates 3 times. Not sure I believe that. I guess we'll find out. Time will tell. But a lot of the indicators, the inflation, listening to the Fed, things like that, like all point towards rates going up. But you do have a couple of other indicators that kind of give an opposite of impact or effect. Like, for example, the 30-year rate kind of follows the 10-year T-bill. And that has actually went down over the last few months. Which would mean rates should be going down, but they're kind of holding steady right now. So we'll see, but we do anticipate they'll be higher. Will they get all the way to the 3.5% and the 4% that some and most are predicting by the end of 2022? I'm not sure I buy that, but it's possible. It's out there.
Here's my prediction. And of course, we don't know. We don't have a glass ball, but I think we'll land at about 3.7, 3.85-ish. But I don't think we'll tip that 4% like they were forecasting this summer when the growth was occurring before Omicron and all these new variants came out. But we'll see. I mean, bottom line is, even anything under 4%, anything in the 3s is a sale. I mean, that is really inexpensive. I mean, we think of the history of HillsBank here. We go back to the 80s and we were at 17, 18%.
At times, yeah.
My first mortgage was 6.5%. So I mean,
yeah. Well, I started doing mortgages 20 years ago, and the rates were just above 7. We were thrilled when they went below 7, and then they went below 6, and now here we are. And
it seems like the last 10 years, it's like, oh, we'll never go lower. We'll never go lower. And so everything's still on sale. That's the good news.
Yeah, and actually I was looking at some rates earlier just to find out. So our lowest I ever saw for us was 2.25 on a 30-year fixed.
Wow.
And that was in late July, early August of 2020.
Okay.
And so when you think about it, that was the absolute low point. And right now we're, approximately 2.875. So we're only about 0.5% off of the all-time lows.
Yeah.
So even at 3.25, these are historically great rates.
Absolutely. Yeah. Probably never see it again. I mean,
like you said, we've said that before.
Crystal ball,
but you're right. Yeah. There's a good chance of that.
But it gives a lot of buying power. So that kind of goes into my next question. What is your prediction for the spring market? I mean, 2021 was insane. I mean, it was busy. How do you think 2022 will be?
Well, I typically defer to you on this one. But we talk about this in our sales meetings, and we're expecting maybe a record year for purchases this year. Inventory's low. There are some indicators out there. There were a lot of new housing starts last year. Many of them didn't get finished. Those get finished early this year. Put those on the market. Now those homes become for sale. When people buy the new ones, now their existing home comes for sale. So could add a little inventory, but it's still going to be extremely low. But we're expecting record sales nationwide for sure, and we think we're right in line with them here. We're expecting that locally. Yeah,
I think the growth in the Iowa City area right now is really just an exciting time to be here, and there's a lot of people moving into the area. But we're projected nationwide to have about a 6.6% increase in demand, and that demand is going to really just fuel the spring market, and that's my prediction. But we'll see. I mean, there's still the supply chain issues, as you mentioned, but there's 45 million millennials now becoming first-time home buyers that are entering the market. And that's exciting. That'll be,
That is exciting.
So we'll see. I mean, I'm excited to see what's going on the next year. Bob, I appreciate you sitting down, giving us all an update on what's going on in the mortgage lending. If you want to contact Bob, I'll put his contact information right in the comments below. If you have any questions about real estate in the Iowa City area, give me a call. Thanks for watching.